Wait, let me get this straight. Over the weekend, the United States military executed one of the most aggressive foreign interventions in modern history. We didn't just sanction a country. We didn't just launch a few drone strikes. We physically invaded Venezuela, captured President Nicolas Maduro, and effectively declared that Washington, D.C. is now running the government in Caracas. By every textbook definition of geopolitical risk, the markets should be puking right now. We should be seeing a flight to safety. Bonds should be rallying, stocks should be dumping, and the VIX, the fear index, should be screaming into the stratosphere. But look at your screen. Look at your portfolio. The S&P 500? All-time highs. The Nasdaq? Ripping higher. Emerging markets? Green. It is Tuesday, January 6, 2026. The United States has just engaged in a massive regime change operation in South America, and Wall Street isn't panicked. Wall Street is celebrating. This is the most dangerous disconnect I have seen in my entire career. We are witnessing a fundamental rewriting of the rules of global finance. The market has decided that war is no longer a bug in the system, it's a feature. Today, we are going to peel back the layers of this insanity. We're going to look at why the algobots in New York are buying the invasion, what this means for the massive AI bubble that's currently propping up the economy, and most importantly, why the US dollar might be silently bleeding out while stocks hit record highs. If you hold US equities, if you have a 401k, or if you're trying to buy a home in this chaotic environment, you need to understand why the market has stopped caring about the apocalypse. Let's dive in. Let's rewind the clock just a little bit. If this invasion had happened in 2018, or even 2022, the markets would have cratered 5% in a single session. Uncertainty is usually kryptonite to investors. But today? In 2026? We have developed a callus. Financial markets have been subjected to what I call geopolitical shock therapy ever since President Trump returned to the Oval Office. Think about the last 12 months alone. We had the kinetic strikes on Iranian facilities. We had the heavy-handed intervention in Yemen to clear the shipping lanes. We had the skirmishes in Syria. Each time, the media screamed World War III, and each time, the S&P 500 dipped for maybe 48 hours before ripping to new highs. The Pavlovian response of the modern investor has shifted. It used to be, war equals uncertainty, sell everything. Now, the algorithm is, war equals government spending, no disruption to US consumption, buy the dip. Charu Chanana over at Saxo Markets in Singapore put it perfectly this morning. She noted that equities simply fade headlines unless there is an immediate hit to global demand or supply chains. And that is the key phrase, immediate hit. Wall Street has become incredibly short-sighted. The traders on the floor of the NYSE look at the Venezuela raid and they ask two questions. 1. Did this stop Americans from buying iPhones? No. 2. Did this stop Nvidia from selling chips? No. Therefore, buy. We are seeing a psychological adaptation to the breakdown of the post-World War II rules-based order. For 70 years, the global economy relied on the idea that borders were sovereign and invasions were rare. That era is dead. We are back to a 19th century style of gunboat diplomacy, and frankly, the stock market loves it because it implies American hegemony is being enforced by the barrel of a gun. But here is the catch that nobody is talking about on CNBC today. This complacency is built on the assumption that these conflicts will remain local. The market is betting that Venezuela rolls over, that the Venezuelan military defects to the US side, and that this doesn't spiral into a guerrilla war that drags on for a decade. It is a massive gamble. The market is pricing in perfection in a military operation. And if history has taught us anything, from Vietnam to Afghanistan, it's that military operations are never perfect. Now, let's talk about the commodity that usually dictates the flow of history, oil. When the news broke on Saturday that US boots were on the ground in Caracas, the knee-jerk assumption for any amateur trader was, go long on oil. Venezuela holds the largest proven oil reserves on the planet, more than Saudi Arabia. Logic dictates that an invasion disrupts supply, causing prices to skyrocket. But what happened yesterday? Crude prices initially fell. They wobbled, dipped, and then ended the session only slightly higher. Why? Because the market is looking at Venezuela as a distressed asset that the US just acquired in a hostile takeover. Venezuelan oil production under the Maduro regime had collapsed. PDVSA, the state-run oil company, has been rotting from the inside out for years due to corruption and lack of maintenance. The infrastructure is rusted, the engineers fled to Miami or Madrid years ago, and the output was a trickle of what it used to be. The smart money, the hedge funds and the commodity trading houses like Glencore and Trafigura are betting that a US-led administration in Caracas is going to open the floodgates. They are pricing in the return of ExxonMobil, Chevron, and Halliburton. This is the wallet connection you need to pay attention to. If you are holding energy stocks, specifically the US supermajors, this is a potential goldmine. The thesis is that American engineers, protected by the American military, will go in, fix the pumps, and bring millions of barrels of heavy crude back onto the global market. If that happens, we aren't looking at an oil shock to the upside. We are looking at a supply glut. We are looking at oil crashing to $50 or $40 a barrel in the long term. That is deflationary. That lowers the cost of gas at the pump in Ohio and California. That lowers shipping costs for Amazon. That is why the S&P 500 went up. The market is viewing this invasion not as a war, but as a restructuring of the global energy supply chain. However, this is where the future outlook gets murky. This optimism assumes the pipelines won't be blown up by insurgents. It assumes the Venezuelan people will welcome US corporations with open arms. If we look back at the Gulf War in 1990 or the oil crisis of the 1970s, markets crashed because supply was physically removed from the market, driving inflation through the roof. Deutsche Bank's Jim Reed pointed this out in a note yesterday. Geopolitical shocks only matter to the stock market if they cause a sustained rise in inflation. Right now, the market believes this invasion is disinflationary. They believe Trump just secured cheap gas for the next 4 years. It's a cynical, ruthless calculation, but that is how the market thinks. If oil explains the energy sector, what explains the rest of the market? Why is tech flying? We have to acknowledge the elephant in the room: artificial intelligence. We are in the middle of a capex supercycle that rivals the build-out of the internet in the late 90s. Companies are spending hundreds of billions of dollars on data centers, GPUs, and energy infrastructure. Tai Hui from JP Morgan Asset Management hit the nail on the head. He said, investors are still focusing more on AI development, since this has been a driver of markets for the past few years. In the eyes of a tech investor in Silicon Valley, who cares who runs Venezuela? Does the fall of Maduro stop the deployment of GPT-6? Does it stop the integration of AI into healthcare or finance? The narrative driving this market is that AI is going to create a productivity miracle that makes geopolitical borders irrelevant. It is the ultimate bread and circuses. As long as the earnings of the Magnificent Seven tech stocks keep growing, the market will ignore almost anything short of a nuclear detonation. But there is a second pillar holding this market up, and it's our old friends at the Federal Reserve. The economic data coming out of the US lately has been lackluster. Manufacturing is slowing, consumer credit is tapped out. In a normal world, that's bad. But in the clown world of modern finance, bad news is good news. Why? Because weak data means the Fed will keep cutting interest rates. We are in a situation where inflation is slowing, allowing the Fed to pump liquidity into the system. So you have a perfect storm for a stock market melt up. 1. AI hype, a secular growth story that promises endless profits. 2. Fed liquidity, cheaper money making it easier to leverage bets. 3. Geopolitical cynicism, a belief that US military aggression will secure cheaper resources. This triumvirate is creating a force field around the stock market. But I need to warn you, this is exactly what a bubble looks like before it pops. When investors stop pricing in risk because they believe that AI story is invincible, that is when you get the sharpest corrections. We saw this in 2000. The dot-com stocks were soaring while the geopolitical situation in the Middle East was deteriorating. Eventually, reality caught up. So far, I've explained why stocks are up. But there was one asset class that didn't join the party on Monday. The US dollar ended lower. This is the canary in the coal mine. This is the signal that smart macro investors are actually worried about. Stephen Dover from the Franklin Templeton Institute made a very polite comment about this. He said the ouster of Maduro may add to further weakness in the dollar over time as more countries shift away from the US currency. Let me translate that from financial speak into plain English. When the US military invades a sovereign nation, captures its leader, and seizes its assets, every other country on earth takes notice. If you are Brazil, if you are Saudi Arabia, if you are Indonesia, you are looking at this and thinking, if I cross Washington, my assets are zero. My sovereign immunity is zero. This accelerates the trend of de-dollarization. We saw this start with the Russia sanctions in 2022. It ramped up with the trade wars. Now, with the physical seizure of Venezuela, the trust in the US dollar as a neutral reserve asset is being eroded. Why did gold and precious metals extend their momentum? Because gold is the only asset that is nobody else's liability. You can't sanction physical gold in a vault in Shanghai or Zurich. You can't hack it, and you can't delete it. The stock market is partying because it sees short-term profits. The currency market is selling off the dollar because it sees long-term institutional decay. If the world decides that the US dollar is too weaponized to be safe, they will stop buying US treasuries. If they stop buying treasuries, yields go up. If yields go up, the cost of servicing the US debt, which is already at astronomical levels, becomes unsustainable. This is the nightmare scenario. Not a stock market crash, but a sovereign debt crisis triggered by a loss of faith in the American empire. We saw the Mexican and Colombian pesos pair their declines yesterday. Why? Because the market realized, okay, the US isn't attacking us, they are just consolidating the region. It's a return to the Monroe Doctrine of the 19th century, the idea that Latin America is the US's backyard and Europe needs to stay out. While this projects strength in the short term, it breeds resentment in the long term. And in a globalized economy, resentment is expensive. We need to look at history to see where this goes next. There are two primary historical analogies we can draw here. Scenario A, the 1990 Gulf War. In 1990, the US assembled a massive coalition, crushed the Iraqi army quickly, and restored order to the oil markets. The initial shock caused a dip, but once the victory was decisive, markets rallied, and the 1990s became one of the greatest bull runs in history. If the Trump administration can stabilize Venezuela quickly, install a pro-business government, and get the oil flowing within 6 to 12 months, we could see a repeat of this. This is what the S&P 500 is pricing in right now. Scenario B, the 2003 Iraq invasion. The invasion was quick, but the occupation was a disaster. It drained the US Treasury, distracted from domestic issues, and eventually led to massive instability. However, and this is key, even during the Iraq War chaos, the stock market largely recovered after the initial invasion. It wasn't until the housing bubble burst that things fell apart. But there is a darker, third scenario. Scenario C, the 1973-1979 shock. If this invasion triggers a broader conflict, if rogue elements in Venezuela sabotage the oil fields, or if other Latin American nations form a bloc to embargo the US, we could see a reverse oil shock. If oil goes to $150 because of sabotage, the inflation is slowing narrative dies instantly. The Fed has to hike rates. The AI bubble pops because capital becomes expensive. My forecast for 2026, in the short term, the Trump trade will continue. The market loves deregulation and it loves the projection of power. Defense contractors like Lockheed Martin and RTX are obvious buys here. Stephen Dover mentioned supporting defense spending around the world, and he's right. Every country is going to arm itself to the teeth seeing what just happened. However, as we move into the second half of the year, the sugar rush of the invasion will fade. The reality of occupying a nation of 28 million people will set in. We will likely see the dollar continue to bleed against gold and crypto. We are moving into a world of bifurcated markets. The US bloc, stocks in the US go up as capital flees chaos elsewhere. The hard assets, gold and silver, go up as trust in fiat currency goes down. The losers, European and Asian manufacturing that relies on stable global trade routes, which are increasingly fracturing. So, what do you do with this information? How do you protect your money when the world is on fire but the stock market is acting like everything is fine? 1. Don't fight the tape. The momentum is currently to the upside. The AI narrative and the Fed rate cuts are powerful forces. Shorting this market right now is like standing in front of a freight train. The Trump bump combined with the Venezuela resource grab is currently being viewed as a net positive for US corporate earnings. 2. Watch the oil majors. Keep a close eye on who gets the contracts to rebuild Venezuela's energy grid. This could be the growth story of the decade for legacy energy companies. 3. Hedge with chaos insurance. The weakness in the dollar is real. The fact that gold is maintaining momentum even as stocks hit highs tells you that the smart money is hedging. You should too. Whether it's physical gold, ETFs, or Bitcoin, you need assets that are outside the traditional banking system. If the global backlash against the US invasion intensifies, these assets will be your lifeboat. 4. Monitor the bond market. Ignore the stock market headlines. Watch the 10-year Treasury yield. If foreign nations stop buying US debt in protest of this invasion, yields will spike. If the 10-year yield breaks above 5% again, that is the signal that the party is over. We are living through history, folks. The US has just signaled that it is willing to use brute force to secure resources and maintain order in the Western Hemisphere. Wall Street is cheering, but the long-term cost to the status of the US dollar remains to be seen. Do not get complacent just because your brokerage account is green today. In this new era of geopolitical volatility, the wind can change direction in a heartbeat. Stay liquid, stay skeptical, and keep watching the charts. I'll see you in the next video.